Hi there. Welcome to The Close. I'm Lindsay Biscaya. Markets are closing in half an hour from now. So first, let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The Canadian economy slipped into a recession to start the year. Data from StatsCan shows first quarter GDP unexpectedly fell 0.1%, held back by weak business and government spending. Economists had forecasted growth of 1.5%. Canada's GDP has now contracted for 2 consecutive quarters, marking the first technical recession since 2020. And we got some insight on what possibly contributed to that data.
It's the old adage that if the U.S. sneezes, Canada catches the cold. But there's also obviously a lot of things going on with trade. It's kind of deterring investment in climate has been very poor in Canada because you're not sure what the end regime is going to look like. So a lot of these things have slowed and population growth has slowed. We've cut back on immigration. So a lot of the key drivers of some of the things that were working for us in terms of GDP growth have kind of gone flat.
Oil prices, meanwhile, are down today after U.S. President Donald Trump indicated he will make a final determination about a deal with Iran. He says there are multiple conditions for a deal, including an immediate reopening of the Strait of Hormuz without tolls to unrestricted traffic. Trump also says the U.S. naval blockade against Iran will be lifted, although he didn't specify when. And Bloomberg News is reporting Chinese-made EVs have started to arrive in Canada. According to the report, a vessel carrying a small number of Chinese-made Lotus luxury cars departed from Shanghai and is now moored outside the port of Vancouver. The cars will be the first imports under a deal that allows up to 49,000 Chinese EVs in a 12-month period at a lower tariff rate. And we're watching the TSX today. It is making some gains after seeing gains yesterday as well, up ever so slightly by 0.3%. It's a similar story if we look at markets in the U.S., all in the green today as well. The Dow Jones in particular up by almost a full percentage point at this point. Obviously, this comes, as we said, Donald Trump is talking about potentially reopening the Strait of Hormuz and lifting the U.S. blockade, and it seems investors are feeling pretty good about that news today. Canada has dipped into a technical recession for the first time since 2020. Joining us for more on this is Kevin Burkett, Portfolio Manager at Burkett Asset Management. It's great to have you join us. Good afternoon.
Good afternoon, Lindsay.
So maybe can you explain to our viewers first off what exactly a technical recession is?
Yeah, so technical recession here is we've now got a year-over-year annualized 0.1% economic contraction. So I wouldn't overstate the some of the media commentary around the unexpected nature of this. I think it's well known in markets that the Canadian economy is stagnating. I think when I look at the corresponding reaction in rates and currency markets, it was pretty muted this morning. When you're talking at a country level on GDP results, it's a cauldron of forces. And so when you think about, clues for what's causing that, I mean, I think everybody notes the U.S. Tariff rhetoric isn't helping. Certainly that's softening the business outlook. But when we look one layer deeper into the detractors that contribute to that result, some of the government spending, which is being curtailed, is having an impact. As well, I think Canadian households are under pressure. And this week we got some interesting clues in bank earnings in terms of the health of the Canadian household. And I think there's a few things beyond the obvious, uptick in fuel prices that are contributing to that. And I'd say some of this is rate driven. If you look at the timing of this, if you think about the last two-quarter contractions, it was last in COVID that we saw a two-quarter contraction. And that was 2020, 2021. So you've got a group of borrowers there, household borrowers, who were able to tap mortgage rates at fairly attractive levels, 1.5% to 2% rates, that are seeing those mortgages renew at the 4% to 5% range. And so there's a lot of contributors here beyond just the Canadian and U.S. trade relationship that I think are mounting as headwinds to the health of the Canadian economy.
Do you think it's a concern, though, the numbers we're seeing today? Like, does this signal a deeper slowdown ahead?
Well, of course, it's a concern. I think if I look ahead to catalysts, you've got the formal review of the USMCA happening, starts July 1st. That is, I think, commonly misunderstood, the significance of that date. It's more of a renewal of vows than it is a sort of a discovery period for whether that's a healthy relationship. I would say the clues for the health of the U.S.-Canada trade relationship are coming to us in more or less real time. Trump this morning came out with his expectation that U.S. auto content would be 50% in the U.S., which is interesting. You've got your headline there about Chinese EVs coming over. I think Carney, in his charismatic fashion, is pointing to middle powers in a way that he might not if the Canadian-U.S. Trade relationship were better. And so as far as concerns, I think absolutely we have right to be concerned. But the significance of that result today, I would say markets were not surprised in the reaction that we saw, and that would be, GDP results typically show as whether it strengthens the case for the Bank of Canada to cut rates or not. And I would say, given today's move in rates and currency, not itself surprising information.
Okay. I did want to move on and talk a little bit about bank earnings, because obviously we saw the big six banks reporting this week, but a lot of other banks reporting as well. Laurentian, EQ. I know you wanted to hone in on Laurentian because it reported weaker than expected second quarter earnings. What do you think went wrong here?
Well, look, I think this week's earnings has been really interesting in that it reinforced a growing divergence between banks. And I think there are some banks that have a resilience, diversification in their business models. Larger banks doing better, capital markets, one of the parts of banks that's working. When you look at smaller banks, what you find is markets are rewarding earnings quality. They're looking for stable provisioning. They want to see capital return, and they're punishing weaker net interest margin trends and some of these impaired loss claims. So when you look back at the scorecard in terms of what banks have reported and how they did, all 5, 6 of the banks beat expectations. Laurentian, something of an outlier for its miss, and that's, I'd say, more so an orientation away from capital markets. I think provisions is another area. I think provisions are based on forward-looking estimates, and making reasonable provisions, I think you can lose market confidence if you don't make the provisions that we find are ultimately necessary. But whether Laurentian sets aside more or less money for potential credit losses, it itself doesn't matter much. What does matter is whether that commercial loan book is as healthy as we would hope. And I would say the higher provisions, it's the reduced earnings impact that everyone worries about, and I think only time will tell. So what you're seeing is less a Laurentian specific problem and more that Laurentian lacks exposure to the parts of banks that are working best, namely capital markets. Okay,
I did want to move on. Once again, you've got a couple of stock picks or stocks that you're watching today making some news. Colliers International is one of them. It was down quite a bit earlier today. Now it's down under a percentage point at this point, so by 0.7%. But tell us more about what you're watching for here with Colliers and why you're watching this stock so closely.
Sure. So Colliers is a stock that's fallen fate to investor concerns around AI disruption in professional services. So the Colliers, we all know, is a commercial real estate brokerage. There are other parts to Colliers' business, though. There is really a move into recurring business lines. And what I mean specifically is the investment management, the engineering parts of that business. And I would say that company has shifted toward a recurring higher margin business model. When I come back to the commercial brokerage, which is, I think, what is the source of the concerns that have taken Colliers lower, and why I see Colliers at this level as an attractive entry point, is that I think there's a necessary human element in the nuanced nature of how buyers and sellers come together in that market and how sensitive information is handled.
Okay, and we're just going to get to your last one as well. Constellation Software is another stock pick for today. What are you watching there?
So similar theme, AI overhang. I think there's a sense that AI comes to replace software. And the reality is I think AI actually increases software usage, the necessity of that software. I last spoke about Constellation when I was in your studio there back in March. And what I would say is the early signs are that we're calling that right. The financial results for Colliers have improved. Quarterly results show an uptick in usage of that software, and stock's up roughly 10% since I mentioned it. And I think there's still opportunity for that share price to retrace. If you look at it on a 5-10 year horizon, that stock doesn't decline very much for very long. And we see this as a good opportunity to build a position in a very high quality earnings compounder.
Okay, trying to cover a lot of topics there in a short amount of time. Kevin Burkett, Portfolio Manager at Burkett Asset Management. Appreciate your time. Thanks so much.
Cheers.
Coming up next, Canada has entered a technical recession, and that's according to the latest first quarter GDP figures. So we'll break that down further when we come back. Stay with us. The Canadian economy slipped into a recession to start the year. Data from StatsCan shows first quarter GDP unexpectedly fell 0.1%. Let's dig into the numbers a little more with Mark Parsons, Vice President and Chief Economist at ATB Financial. It's great to have you join us.
Thanks for having me.
So what do you think were the primary factors slowing Canada's economy in the latest quarter?
Well, first of all, let's just call it what it is, a very disappointing report. The Bank of Canada had 1.5% annualized growth. It came in slightly negative. So now we're at 2 consecutive quarters of negative growth. Technical recession, whether it's an actual recession is to be determined, but definitely weak readings. There's some temporary factors that I'm not too concerned about. So there was a decline in government spending on weapon systems and things like that. So that's just coming off really high levels. So not going to get too worked up about that. There's a spike in imports, particularly of gold, so that could be a temporary factor as well. But if you look at some of the underlying trends, if you just look past this one quarter, you see persistent weakness in business investment, which is a bit troubling, and exports. And that's really what I'm looking for to drive the next leg of growth for the Canadian economy. And we're just not seeing it yet. Mm-hmm. There's a lot of trade uncertainty, of course, holding things back. But that's where we need to see some of the growth. And in the household, actually, in the first quarter, they slowed their purchases, but they're basically the only ones contributing that in inventories to the Q1 GDP. So that is another thing I'm looking at is like how much longer can the consumer drive the Canadian economy?
I wanted to talk about the business capital investments because you just mentioned that. It fell for a 5th consecutive quarter. We've seen Prime Minister Mark Carney's initiatives to bring more capital into the country. Are you surprised nothing he's been doing is showing up yet in the data?
Yeah, we're still waiting for that. I mean, really, the signal's been sent. We've made some big plans. Prime Minister Mark Carney wants to catalyze $1 trillion of investment over the next 5 years. First year, we're not seeing much evidence that is happening. It's early days. They just started the Major Projects Office. It takes a long time to get these projects coming online. But I think what we're seeing here in the data with business investment falling yet again, we need this to happen sooner than later because look, the consumer's under pressure right now. Higher energy costs, that's not going away anytime soon. Bank of Canada is probably going to stay on hold, so they're not going to get much relief there. I just think this is the time, and we have to accelerate some of these major projects and get shovels in the ground.
What about tariffs? Did you see that as a significant factor in Canada's slow economic growth this year so far?
It's there. It's more just that lingering uncertainty about CUSMA, the review that's going to take place this summer that's holding things back. I think that's leading to a very cautious stance among businesses. But tariffs themselves are better today than what we thought they were going to be this time last year. So I think that's important to keep in mind. We have the CUSMA exemptions. You have sector-specific tariffs that are weighing on steel, aluminum, autos. But tariffs are not as big of a story this year than they were this time last year. So we really do need to get onto what we can control here within Canada, which is getting some of these major projects built, and that will lead to higher exports. But it's hard to get the exports without the investment.
I want to switch to imports instead because we saw an increase in gold imports in the latest quarter. What contributed to that?
Yeah, the import data is very volatile. So what you saw is accumulation of inventories that actually propped up the Q1 numbers, but it was the opposite in Q4. There was inventory withdrawal. So I see that just as a one-time factor. It was a purchase of gold. We don't see that holding going into Q2. And so hopefully in Q2, we get some of those one-time effects coming off, and then eke out some modest growth in the next quarter. That's what we're expecting.
And obviously, we've seen the current crisis in the Middle East pushing up, demand for energy, oil prices. Do you think Canada's doing enough to capitalize on that right now?
Well, there's some early positive signs, right? I mean, we have the announcement of Germany interested in buying Canadian LNG. That is likely to lead to more LNG projects. We think LNG Canada Phase 2 is more likely now that Shell has purchased ARC. There's positive talk about building pipelines, West Coast Pipeline, but there's still a lot to wait for there, and that we're not anywhere close to the finish line. So I think we're headed in the right direction. The question is, can we act quickly, given that we're in a current crisis, and the world wants what we have, which is an abundant supply of energy responsibly produced. So I think that's where a lot of the upside is in our forecast, is if we can get some of these major projects built. And even in the current environment, we see that growth is going to be very uneven, where the energy producing provinces like Alberta are gonna fare better. But it's not expected to be a boom unless we get more clarity on some of these longer term pipeline projects.
For sure. Okay, we'll leave it there for now. See what happens next. Mark Parsons, Vice President and Chief Economist at ATB Financial. Appreciate you joining us. Thanks so much.
Thanks for having me.
Up next, we'll take a closer look at Dell's latest earnings when we come back. Stay with us. Dell is the top gainer in today's trading, surging more than 30% after a strong quarter in which revenue rose nearly 88% year over year. The company also raised its forecast for the fiscal year. So let's get more from BNN regular Ivana Delevska, founder and chief investment officer at Spear Investment. It's great to have you join us. Thanks so much.
Thanks for having me, Lindsay.
Dell currently up more than 30% right now, 31%. Is this just a short-term bump, or do you think we're going to start to really hear Dell's name more often moving forward?
So, Lindsay, we believe that this is a start of a new trend driven by agentic AI. And I'll explain a little bit about what that means. The way we used to train models during the AI training era used to be using a lot of GPUs and very few CPUs. Now we're moving to a new era where the inference phase really uses a lot more CPUs, which are very similar to the traditional servers. So if you look at Dell's results, where they really out-delivered was not only in their GPU AI servers, was really more broad-based traditional servers. And that trend, I think, is going to continue. This is the first quarter that we're seeing it, and it's a big step up in order growth.
Because Dell reported that its AI server revenue increased by 757% year over year. Where was that growth primarily then? Was that on assembling GPU clusters?
Well, basically, all of GPUs, all of servers over time are going to become AI servers. The question is going to be, is it servers used for model training, or is it servers used for inference? We believe the growth is going to really come more from the inference type servers. And this is why you saw basically from the model training era, about a year and a half ago, orders jumped from about 2 billion to 12. And now you're seeing that same type of step up in this agentic era, because basically all of these AI agents basically function as people, right? So all of a sudden you have all of them come online, and they're really consuming a lot of these enterprise size servers.
Okay, so you say you see additional upside for Dell once it really begins assembling servers with CPUs. Is that right?
Absolutely, absolutely. And I think it's also going to have much broader implications for the entire value chain. Anybody that's selling CPUs, anybody that's selling networking, these are the types of areas that have incremental type demand. So we still have the GPU demand. We still have the same type of like power usage and LAN demand that we had before. Now, these areas like GPUs and networking have an incremental step up due to agentic AI.
The company also sells data center equipment and networking gear. How else are they capitalizing on the AI build out apart from what we've already talked about?
Well, to my prior point, Lindsay, now basically everything that Dell does is going to become AI. So networking is benefiting from it as well. Literally across every sub-segment that the company sells and every product, they were able to surprise to the upside.
Who else, who are Dell's key competitors that you're also watching for, or do they really have any at this point?
So they do have many competitors. HP is the biggest competitor, so they're going to see similar type of growth. Dell has been particularly good on this execution side. But I think if you move further down the value chain, you can invest in the CPU suppliers, and that's where we're seeing the most upside. ARM is one company that we own. It's now among our top 10 holdings, and we disclose all of our holdings on our website. Additional ones are AMD, Intel. That's why you've seen these stocks move. And then on the networking side, you have companies like Coherent, Lumentum, Astera Labs. They're all going to benefit from this type of incremental growth in infrastructure demand.
Is Dell currently exposed to the global memory shortage that's driven by the AI boom?
Well, it really depends on the end customer. Most customers right now knew about the shortage, so they planned ahead of it. So, for example, NVIDIA wasn't really reporting any supply constraints because of memory shortages. I think the memory shortage is affecting more tangential areas where customers weren't quite expecting this surge in memory demand. So all of a sudden, all available memory has been allocated to AI, which is why companies in the AI space are not seeing shortages, but everybody else is seeing the shortage.
And the company also discussed pricing challenges resulting from current inflationary environment. Do you believe the inflation on things like helium, fuel, other critical raw minerals could slow the AI CapEx cycle for companies like Dell?
Well, that's a great question, Lindsay, because this was the first quarter when we saw CapEx increases from the hyperscalers that didn't actually equal more capacity. So basically, all of the dollar increase in CapEx went for paying for more expensive components, higher priced memory, and so on. So we believe that this is real. The inflation in AI is real. However, the returns on investment that all companies are getting across the board are also pretty outsized. So we think this is something that can continue. And ultimately, you need to have a business model that's strong enough where you can pass on those price increases.
Okay, we'll leave it there. Ivana Delevska, founder and chief investment officer at Spear Invest. Really appreciate your time. Thank you. Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells. At the NASDAQ, the Elmate Group is ringing the closing bell. On the New York Stock Exchange, Dr. Reddy's Laboratories Limited is ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya, and here's how we close the day on Bay and Wall Street. And the TSX finished the day in the green, up 0.5%. The S&P 500, though, and the NASDAQ are two we're watching closely. Both hit fresh record highs once again today. You can see the NASDAQ in particular getting really close to hitting that 27,000 point mark. So we'll continue to watch those. Investors feeling pretty optimistic on the news that Donald Trump says he is going to lift the U.S. blockade in the Strait of Hormuz. Still waiting for exact details, though, on that, but we'll continue to watch that for you. I'm sure most investors will as well. If we take a look at what was leading the TSX today, Celestica is one of the biggest gainers on the TSX. It was up more than 10% to finish the day. There was also a lot of mining stocks in the green today. We saw the price of gold rebounding throughout most of the day because of the news coming out of the Middle East for the most part, and a lot of these companies benefiting from that. So K92 Mining up more than 7%, same with Aya Gold and Silver. And Montage Gold Corporation was up more than 8% to finish the day. On the flip side, closing in the red today, these were some of the stocks. So MDA Space actually closed down by more than 8% to finish the day. It's been on a bit of a run recently, but you can see not so much the case today. 5N Plus Incorporated is another one that finished the day in the red, down by almost 6%. And Imperial Oil also down to finish the day, more than 3%. Obviously, we're seeing the price of oil dropping today because of the news coming out of the Middle East, coming out of Washington as well. And so a lot of these companies affected by that too. And we're going to take a look now at some of the movers south of the border. Joining us is Bloomberg's Avalon Purnell to break down a couple. Avalon, great to see you. So we're going to start with Dell. We were talking about this earlier, but it's seen some real runs today. It had some earnings news. Is that what's really behind this rally that we're seeing?
You're absolutely correct. It did jump about 33% into the close to end at a record high. And that is definitely because of its really fantastic first quarter earnings. It kind of really overshadowed all expectations, whether it be revenue or adjusted earnings per share. And on top of that, it also boosted its full year outlook again for revenue and adjusted earnings per share, which was very much above expectations. And didn't even mention the computers or the traditional servers. All of this is very much because of AI. Worth noting that Bernstein writing that the strength from the earnings appears to be sustainable due to the rise of AI across the sector.
Wow. Replimune is another company you're watching. Those shares nearly doubled today. What triggered the surge here?
You're absolutely correct. Replimune did jump 86% into the close to have its best day since October. And that's after the biotech said that it's going to try for the third time at least to get its skin cancer drug to be approved by the US. More specifically, it said that it had aligned with the FDA to potentially go through the next steps to see how exactly it could get that drug to be approved. And based on the language used, analysts see that this could actually be on a faster timeline potentially. It is still worth noting that Leerink did have a great note out writing that while this is an incremental positive, uncertainties still remain for how the drug will have a path to approval, given it already has been told no twice already.
And lastly, you're watching AST Space Mobile. This one had its biggest one-day drop since 2024. What led to that sell-off?
Yes, it fell 15% into the close, and that's after Deutsche Bank actually downgraded the stock to hold from buy, saying that the Blue Origin rocket blast that happened last night will potentially have a really bad impact on this company in particular. More specifically, it said that because of that rocket exploding last night, AST will not be able to meet its launch target of about 45 satellites that need to go into space by the end of the year. Obviously, for a company that traffics in needing to send these satellites to help reach their goal of eliminating dead zones across the world, without having a rocket, it's kind of impossible to do so. So not necessarily the best news, but that stock is still up a lot if you look at it for the past year.
Okay, we will leave it there. That's Bloomberg's Avalon Purnell joining us live. Avalon, thanks for that. Up next, we've got more on Anthropic raising their valuation and the big investment from Amazon. That's coming up next. Stay with us. Anthropic raised their valuation to $965 billion as it seeks to expand computing capacity to meet growing demand. Joining us for more on this is Brett Winton, Chief Futurist at ARK Venture Investment. It's great to have you join us. Thanks so much.
Thanks for having me.
So seeing Anthropic reportedly boosting its valuation, what does that tell you about demand at this moment?
Well, I think everybody recognizes that Anthropic is extraordinarily well positioned in the enterprise AI space. They're the number 3 position in our fund as of now after this round. And in fact, we have exposure to all of the major, what we think of as frontier model companies, SpaceX, xAI, OpenAI, and Anthropic. And we think that there's a collective $15 to $20 trillion enterprise value opportunity across those companies recognizable by 2030. So I think it's an amazing set of exposures in this moment of AI inflection.
So it sounds that you think that demand for AI models, that demand is sustainable long term.
Yeah, these models are crossing thresholds where people are actually able to deliver extraordinarily productive work by using the models. And we, humanity, currently pay knowledge workers $30 trillion in wages. So the way we think about it is companies, if they can boost the productivity of their knowledge workers, they won't pay the full freight of that. They'll pay a fraction of that on tokens, but it still results in a market that we think will total $7 trillion in AI enterprise spend by 2030.
And of course, we're all hearing both Anthropic, OpenAI could eventually tap public markets as soon as this year. What do you think a lot of investors would need to see? Obviously, some investors are already comfortable with that, but getting comfortable with an IPO at that scale.
Well, I think it'll be actually quite nice when and if they do list, because it'll provide transparency as to what's going on financially within the companies. I think that there's a misperception. People think this is, hey, these are just subsidized VCs like paying for our tokens rather than unit economic businesses that look really attractive. The easy way to think about an AI company is they are renting GPUs for 10 to 15 billion dollars per gigawatt, and then they are selling tokens attached to those GPUs for 30 or upwards billion per gigawatt. It's basically transforming the GPUs into intelligence. And I think that being able to see the underlying unit economics of these businesses would give people a lot of comfort as to how these are really sustainable growing businesses.
You talk about that transparency with companies going public. Is there something you're hoping to learn about either OpenAI or Anthropic when we get more details about how they run?
Well, I can tell you, with the SpaceX filing, which we're following closely because it's our largest exposure, it really helps you to understand the full cost structure of the business when you have audited financials that are extraordinarily well detailed. And with all of our exposures in venture, we have really close relationships with management teams. So we get into data rooms and we really dig into what's going on with the underlying businesses. I'm more excited about, the broader public understanding how these businesses work, the mechanics of the underlying financials, because I think there are misperceptions out there, and that colors people's view of this entire cycle. I've heard it stated again and again, oh, AI is obviously a bubble. Actually, given our expectations for spend here, the investment in underlying infrastructure is more than justified, and in fact, it's quite necessary.
We've seen Amazon already committing up to $25 billion into Anthropic. I wonder how important you think these big like tech partnerships are when it comes to shaping the AI competitive landscape.
Yeah, I think that the enterprise AI opportunity is ultimately not going to be a winner take all. It'll be split amongst a handful of companies, just like infrastructure as a services. And the share that those companies have will be a function of how much of their compute they've thrown at training to create efficient and powerful models, and then how much compute do they have to service their customer base that they've captured. And so SpaceX, xAI, OpenAI, and Anthropic are all jockeying for future contracted compute, because that's ultimately going to determine, what kind of revenue they can generate in the future. These kinds of partnerships that Anthropic's signing, while they're a little late to the game relative to OpenAI, and they don't have the launch and orbital compute opportunity that SpaceX does, do help to solidify its future strategic position for the enterprise opportunity.
I want to switch gears now and talk a little bit more about Dell, because we saw the stock price for Dell going way up today, past 30%. What specifically about Dell's AI strategy in the latest quarter really seemed to speak to investors and help them grow?
Well, I think you can say across the board, it's not just GPUs that are seeing skyrocketing demand. There is demand for the entire technology stack, CPUs, certainly memory. And a way to think about that, as we're all turning on agents, those agents each need effectively their own dedicated computer. And so rather than just having the billion knowledge workers out there using computers, you are spawning new knowledge workers that need their own dedicated tooling. And so it just drives demand, across the entire technology industry, including some companies that you would think of as being relevant last cycle, but not relevant again. And so in the semi space, it's clear that this could rejuvenate Intel's efforts, and Dell's an example as well.
And heading into this quarter, about a third of analysts were neutral or bearish on Dell. Does this quarter fundamentally change the investment case, or is there still reason for caution around this company?
Well, I mean, I'm not going to comment on exactly how much is baked into Dell, but I can say that there is clear structural demand for technology. The world is under software. Every single digital agony that you face in your life is a function of bulky software that's ineffectively implemented, that doesn't fit well with how you operate in the world. And in order to solve that, it's actually going to require a lot more investment in fundamental compute infrastructure. Now, that could flow through Dell, and it could flow away from a lot of traditional businesses that seem to be operating fine, that are, generating cash, but they have debt against their balance sheet. So I think if people are looking for kind of areas that are going to be disrupted, this digital spend is taking money from some other pockets of the economy, and it'll be interesting to see which businesses actually get disrupted along the way.
Okay, Brett Winton, Chief Futurist at ARK Venture Investment. Really appreciate your time. Thanks for joining us.
Sure.
Coming up, we'll look at 3 hot picks in the tech sector when we come back. Stay with us. It's time now for Hot Picks, and today we zeroed in on the tech sector. For more, we spoke with Jed Ellerbrook, Portfolio Manager at Argent Capital Management, and we kicked things off with his thoughts on Microsoft.
It's been caught up in a lot of the software disruption from AI fears, and I think that's unfounded. And we've actually seen Microsoft stock rebound here and perk up over the last month and a half. We think Microsoft is an attractively priced stock, just a hair over 20 times earnings, which for it is on the low side. And I think that they're infusing AI, tools and functionality into a lot of their software products, which is going to make them more relevant for customers and help to continue their growth alongside Azure, which is their cloud computing unit, growing about 40% a year and speeding up here in the next couple quarters. So I think there's a lot of good news. I think Microsoft has deeper ties with its customers than just about any software company in the world. And so we think that they are a software winner. And we think investors are starting to pick through the rubble that has become of software in the last 6 or 9 months and identifying stocks that are going to be attractive going forward. We're seeing that this morning with Okta, which reported results yesterday afternoon.
Any concerns with Mark Zuckerberg's comments that maybe they might be getting into cloud wars with Amazon and Microsoft? He said, what's the quote? It's definitely on the table.
Yeah, it's a really big ocean. Cloud computing, the demand for those services and tools is exceptionally high today. There are a lot of neoclouds that are jumping into cloud computing. SpaceX is rented out some of their AI factory capacity to Anthropic recently. So no, I think right now there's more demand than there is supply. New entrants are coming into the cloud computing industry, but the big boys, Amazon's AWS, Microsoft's Azure, Google's GCP, are in an exceptionally strong competitive position.
They know how to play, and software. The death of software greatly exaggerated.
In some cases, yes. I think there will be, software businesses that struggle to grow in the future as they have in the past because their use to customers is surpassed by new AI functionality. But there are also a handful of software companies, and probably more than a handful, that have very, very strong growth prospects going forward and are going to adopt AI tools, improve their products, and become even more useful for customers going forward. So I think it is going to span the entire spectrum.
All right, let's move on to TransDigm.
Yeah, TransDigm is an aerospace and defense company that has really all parts of their business, all parts of their customer base growing strongly. The defense business is growing. The U.S. Department of Defense budget continues to grow at a high single-digit or low double-digit pace. That's been helpful. And then commercial aerospace is growing strongly as well, both new equipment, new plane shipments from Boeing and Airbus, and then also the aftermarket business sold mostly to airlines. Those are both growing double digits as well. So all customer groups are firing. They also have been doing acquisitions recently, which are contributing new growth to the company. And we think the CEO, who's about at the 1-year mark, is off to a good start in his tenure. What
are some of the acquisitions they picked up?
Yeah, they bought a couple companies out of California. Sierra is the name of one. They're companies that do aftermarket parts mostly for airplanes. So, that aftermarket business is appealing because the products usually are sourced from only 1 or 2 competitors, which gives the supplier, TransDigm in this case, or the companies they bought, good pricing power and also the ability to, project demand forward years in advance with high likelihood.
And does it almost put them into a silo?
It does. Yeah, the aerospace and defense business is extremely siloed product by product, which limits competition within each silo. That's why you see a lot of successful aerospace companies making acquisitions and kind of consolidating the industry. HEICO's been very successful doing that, dozens and dozens of acquisitions over the last year. TransDigm is another group in that category as well.
Okay, and last one we want to get to, Broadcom, the earnings are coming out. It's another one I think people are going to be paying attention to.
Yeah, huge company, huge earnings report coming next week on Wednesday afternoon. Demand for accelerated computing is exceptionally high. We saw NVIDIA's results 2 weeks ago. They're obviously the market leader, but Broadcom and their kind of customer chip efforts are doing very well too. They're the primary supplier behind Google's TPU. They're also working with Meta and OpenAI and a couple other companies to develop their custom accelerator chips. Demand is extremely high. Those customers are placing a very high priority on the internal development of those products with Broadcom's help. So we see exceptionally strong demand. And then, of course, they have, the other half of their business is software, where I think we are seeing sentiment improve. Broadcom stock has done pretty well lately. It's at an all-time high, but I think it's still reasonably priced. Investors have been more excited by other, kind of racier semiconductor stocks, memory, and also recently some of the edge hardware companies. So while semiconductors have been doing great, Broadcom has actually been lagging the group, and we think is a pretty attractive candidate to buy today.
And what are you going to be looking for in the earnings to maintain that optimism?
Yeah, their guidance for next quarter is going to be big. They'll tell us more about TPU ordering plans. Google is now selling those chips directly to customers. And so I think that's a big new step up in demand coming here over the next couple quarters for Broadcom.
And any concerns with AI right now, or does it seem like it's settling in and is real?
Yeah, demand remains quite a bit higher than supply. And so it's all systems go across really the entire supply chain. NVIDIA, of course, leading the way, but so many others at this point following.
That was Jed Ellerbrook, portfolio manager at Argent Capital Management. Up next, we'll take a look at today's top business headlines. Stay with us. Canada's economy is now in a recession after GDP shrunk in 2 consecutive quarters. First quarter GDP dropped due to weakness in resource extraction industries and construction activity. The results fell well below the growth forecast of 1.5%. StatsCan says it's the first recession since the 2020 COVID-19 pandemic. And Laurentian Bank posted weaker than expected second quarter earnings as the bank set aside more money for potentially bad loans. Laurentian says higher loan loss provisions weighed on overall profitability, with the bank's efficiency ratio also deteriorating significantly. And Apotex has filed for an initial public offering in Toronto, setting the stage for one of Canada's largest stock market debuts in recent years. Bloomberg News previously reported the company could raise up to $1 billion through the offering. The generic drug maker says the IPO will include newly issued shares, as well as shares sold by controlling stakeholder SK Capital Partners. USAID's closure placed millions of lives at risk, studies show. U.S. President Donald Trump's new program requires minerals and data as a price of aid. In Mozambique, clinics now face hard choices as Ebola spreads. Bloomberg Originals takes a closer look at that.
There is more constraint on these African countries. Matters were made far worse last year after the U.S. funding cuts.
President Donald Trump has taken aim at the U.S. Agency for International Development, better known as USAID.
While there is new funding coming in now, the healthcare system really has been pushed to the brink.
By the WHO standards, it's quite serious. That is because this new strain of the Ebola virus is one that many people fear has gone undetected for a number of weeks.
This is already, on paper, the third largest outbreak in history, and I think it's going to be exceptionally difficult to contain.
They are really in a race against time in terms of containing diseases and whether they can reform the system as needed. Mozambique's vulnerability to health crises is largely structural. A lot of this is because the country is incredibly reliant on external aid and external funding. That is coupled with climate change shocks. They've seen a lot of flooding in recent years. There's also fighting up north in the country, which has resulted in a lot of displaced people. The United States Agency for International Development, or USAID, was the main way that the American government deployed health funding across the globe. They were really a major health funder in many countries, particularly in Africa. They've covered a lot of very serious diseases like HIV, malaria, tuberculosis, providing aid both in terms of collecting data, actual medicines, and staff. For Africa, this has been vital. In January 2025, President Donald Trump made a series of rapid decisions that effectively dismantled USAID and froze most US foreign aid.
It's been run by a bunch of radical lunatics, and we're getting them out.
The USAID website was shut down, thousands of staff were furloughed or fired, and most contracts were cancelled.
The U.S. State Department says global health programs have become inefficient and wasteful, and its new strategy will assist other countries in developing resilient health systems. But in a break from history, the Trump administration wants access to minerals and health data in return for American aid. Funding cuts to U.S. assistance could result in more than 14 million additional deaths by 2030, according to a study published in The Lancet. Researchers estimated that U.S. aid-funded programs helped prevent about 91 million deaths globally between 2001 and 2021. The largest benefiting region was sub-Saharan Africa. In this graphic, you can see the difference in aid between President Joe Biden's final year in office and Trump's first full year. Billions of dollars of aid have vanished.
When they pulled back aid, it was a massive change. Most of the programs in Mozambique on maternal child health relied on US funds, so you could imagine the impact of that. It was abrupt change, which caught government unguarded. The system just froze. Government didn't know what to do.
The current US-Mozambique deal is a 5-year bilateral health agreement. It was signed in late 2025 under Washington's America First Global Health Strategy. The US is providing $1.8 billion over 5 years. In return, Mozambique commits to increase its domestic spending by about 30%, with the expectation that Mozambique becomes more self-reliant by the end of that 5-year period. There is a risk of a gap. If the Mozambique government cannot adapt quickly enough, that could mean disruptions in what they can provide for HIV and malaria and tuberculosis.
I think there will be impact on different areas. One was a research. You have a health demographic survey, which was mainly funded by US government. So it means that the basic information now is not available to really design programs. There's a gap of information about what is happening in the field.
The situation in Mozambique after the Trump administration's aid cuts is already very visible. There was a specific clinic that we went to where the community-led workers have already halved to about 20 people.
Nós estamos a trabalhar com deficiências porque os cortes afetaram também o número do pessoal. Houve redução do número de pessoal. O que acontece é que continuamos a assistir o mesmo número de pacientes ao nível da unidade sanitária. O que mudou é o tempo de espera. Eu espero que esse novo acordo venha, que traga mudanças na área de saúde.
The new US deal gives Mozambique a funding window and a broad direction. There's more country ownership, more domestic financing, less reliance on outside implementers. But the practical roadmap, how to replace lost capacity and raise health spending in what is really a fiscally distressed country, to rebuild surveillance and sustain HIV and malaria programs, that's still pretty uncertain. One of the biggest risks is that less funding will result in the Mozambican government thinking more short-term. When funding becomes uncertain or constrained, systems like Mozambique's are often forced into firefighting mode, where they prioritize immediate outbreaks or essential drugs and frontline staffing over longer-term investments.
The main challenge is that the gains from the previous investment are lost. Mozambique is not well positioned as a producer of medicines. There's no pharmaceutical industry in Mozambique. So there's a big concern that there's a high dependence on commodities from different markets that we don't have a control. Could have a huge impact on our market.
I think it's a great opportunity for the government because they have now an opportunity to continue to build, because if the government was able to integrate services, pool funding, bring partners together, generate demand, and have this data system in place to track service in 10 days, I wonder what they can achieve actually with a 5-year funding.
In fiscal year 2025, total U.S. foreign aid dropped 23% compared to 2024, according to the Center for Global Development. But that includes 3 months of commitments by the Biden administration. Spending obligations under Trump are on track to sink significantly more. Mozambique, meanwhile, had assistance from the U.S. cut in half last year.
Europe and China may play a role at the margins, but neither is positioned to step in at scale or in the same way as past US support. Many African countries are really working from a position of constraint rather than choice. And so they've got to accept them in many cases because the funding is still substantial, but they are doing it under duress. African countries are responding in a few different ways, and they're not always aligned, pushing back or slowly negotiating over the concerns that they have. Some of the concerns include sovereignty and data sharing. We've seen Zimbabwe reject the deal that they were offered outright, and Kenya, which was the first to sign, is now facing citizen pushback, with that even going to the courts.
In a sharp break from previous U.S. global health policy, the Trump administration has sought to tie health funding to broader agreements. Ghana's president rejected a proposed deal after objecting to requirements that it provide aggregated citizen health data that could be used in U.S. biomedical research, with no oversight of which entities had access to it or a guarantee of shared benefits. Zambia's foreign minister said it was concerning that a health pact was contingent on a broader bilateral compact involving critical minerals and expanded access for U.S. commercial interests.
The countries nowadays, they don't work in silos. There are definitely some regular interactions between Africa CDC and Mozambique to ensure that Mozambique is sharing what's happening on this side and is also aware of what's happening on the other side.
Mozambique is really part of a global web when it comes to health coverage. Diseases don't care about borders. We definitely saw with the COVID pandemic, infectious diseases can move quite rapidly. So if there's going to be widening gaps in coverage, there could be a big problem. Whether there is going to be short staffing or stockouts of various medications, these things are real life, impactful situations where lives are at risk.
Coming up, we'll hear from the president and CEO of Farm Credit Canada when we come back. Stay with us. Canada's agricultural sector is shifting from a traditional export story to a modern growth engine focused on investment, innovation, and global demand. And Farm Credit Canada is helping drive that shift. So for more on what's fueling their momentum, we spoke with Justine Hendricks, president and CEO of Farm Credit Canada.
What they should be paying close attention to is, first of all, as a sector itself today, it's a huge driver of the Canadian economy. It represents about 1 in 9 jobs. It's about $150 billion of our GDP. It's a safe sector. Our food and our food production is sought out around the world. And that's what's bringing a real opportunity as we shed a light on some of the interesting things that are happening in the sector, but moreover, the opportunity for Canada to really step up and take the opportunity to see where we can go with it.
Because I think a lot of Canadians hear agriculture, like that word, and they think only about farming. But when it comes to these opportunities you're talking about, like where do you see the biggest growth opportunities across the agri-foods economy, really?
So great question. And I'd like to say the opportunity is across the entire value chain. So the success of processing depends on the success of farmers. The more innovation and investment in ag tech and ag food is where we're going to see that drive to a higher productivity. But it all starts with innovation and the ability to turn that innovation into scaling opportunities and commercializing them. And perhaps a stat to give the audience a sense, like if you take a look at the performance of the Canadian ag and food sector in the last 10 years, from a GDP growth rate percentage, it's performed better than the rest of the other sectors in the Canadian economy. So it's not just of a new interest, it's a sector that's delivered consistently and now is really positioning itself for the next scaling opportunity.
I wonder though, is there a lot of headwinds within this sector? Because you think of like geopolitical tensions like the trade war that's ongoing. Obviously, the Strait of Hormuz closure has boosted up a lot of fertilizer prices, climate change even. Like, are there some big challenges that this sector is facing, particularly farmers?
There's definitely changes and challenges, but what I would like to say is this sector is definitely known for its resilience. And how you take a look at that too is when you are faced with some of those challenges, the reality is it can also present some opportunities. So it's certainly not to say that some of the geopolitical realities, what we're also tracking around the world, isn't putting pressure on the sector. But what we do know is that in these times, these are some of the most important times for investing. And that, as you work your way through that volatility, gets you ready for when the demand returns or starts to accelerate again. And we also see when I dig into the agri-food side of things, those agri-food companies, Canadian companies that export and export to more than one market are the ones that are being the most successful. So it is definitely a combination of what you deliver and what you bring to Canada, how you set yourself up, but then this ability to scale not just to one market, but to several is really part of the equation of success.
So have you been successful in attracting more, maybe not just you specifically, but the sector, has it been successful in attracting more like large scale investments recently, or is that still something that's been worked upon?
No, well, actually, we do have a start to that. So earlier in the year, we were able to bring together a coalition of private investors, institutional investors, and together, FCC committed in May that we would invest $2 billion in ag and food tech between now and 2030. And this coalition came together and added an additional $5 billion to that commitment. So what essentially that means, the total $7 billion to be deployed to ag and food represents the largest investment or commitment to this sector for at least the last 30 years. So we have been successful in piquing the interest of not just investors that traditionally invest in the sector, but we've been able to seek the interest of those that do not traditionally invest in the sector. And to us, it's a real sign that the story is getting out there and the potential is there and people want to be part of the success story.
Okay, I did want to ask you about that, the $7 billion in investments that you've managed to raise. What kind of opportunities are these investors the most excited in when it comes to investing in this sector? And where do you think the strongest long-term returns could come from here?
Well, I think the opportunities are multiple, right? How the sector, both in ag and agri-food, can lean in on AI opportunities, lean in on automation, and the real desire is to be able to be as best positioned for scale and growth. But in order to do that, we need to bring those ideas to commercialization. And to give you a sense, like we've tracked, if you compare the Canadian investment horizon towards ag and food compared to that south of the border, the ratio of how much investment dollars go to this sector is 23-1 in the U.S. vis-a-vis Canada. So the role of coming together with this coalition was to very much be a catalyst, not just to bring private investors to the sector and to be able to crowd in that capital and invest in those innovations. And those innovations, as they turn into successful ideas and go into production, will connect back to increasing our productivity. So I would argue that the opportunities are across the value chain, and it goes back to that principle that your successful agri-food business or processor needs an input from somewhere. So the success is required to be at the farm gate as well. So, and we see opportunities across the entire value chain.
That was Justine Hendricks, President and CEO of Farm Credit Canada. Coming up, we'll hear from a government affairs and trade specialist about the state of U.S. and Canada free trade negotiations. That's coming up after the break. The Canada-U.S.-Mexico Free Trade Agreement faces a July 1st review. The U.S. has started talks with Mexico, but not Canada, raising concerns about progress as sentiment in Washington appears to be turning against Canada. For more, we sat down with Jacques Shore, government affairs and trade partner at Gowling WLG.
I think I want to be more positive, actually, and I think that it's important at this point, especially after the visit yesterday to New York at the Economic Club by our Prime Minister. I think that, look, we all recognize that CUSMA is certainly the foundation of our economy, and in many ways, it's more than just a trade agreement. So we have to focus on that entirely, and I think all hands are on deck to address it. And I guess I would say if I would have had this interview several days ago, maybe my view of it would be a bit different. One of the things I think is to recognize that while we maybe aren't getting some of the attention that we would want in the White House to address CUSMA, I mean, they're busy dealing with other countries on trade agreements as well. So there's a bandwidth issue that I could see there. But I do think that at this moment, with the visit of the Prime Minister in New York yesterday, there is a bit of a change of approach. There's a recognition that we have a lot to offer the United States, speaking obviously to the investment community there, recognizing the value that we offer. I think we're now at that moment, if I could say, that seven inning stretch to actually move forward. So I'm feeling a little bit more positive.
So what did the Prime Minister say or do that is, I mean, we've been selling that and trying to tout that for a while now. What did he say or do yesterday that maybe hit home?
Well, I love the fact that he actually, referred to the importance of us, being independent, recognizing that we've relied very much on the United States, through these decades in many ways, whether it's defense or otherwise, but also demonstrating that if we are somewhat independent, that's an advantage also to the United States. But at the same time, making it very clear, as he put it, Canada, essentially the North strong and free to help for us to be able to help America be great again. We're obviously an integrated economy. We obviously have a supply chain that values very much how we've approached our issues with respect to CUSMA. And look, there are irritants. There's no question. And so we have to listen. We have to understand a bit more that, those irritants do bother the United States. And how can we accommodate? How do we actually moderate and address those issues? And I think that over the next period, especially as well with a comment made yesterday by Dominic LeBlanc, where he's about to head to Washington, D.C., I think what we should do is think positive. I think that sometimes helps us in moving these issues forward. But look, let's be real. We are going to be in a very difficult moment if we reach July the 1st and we suddenly find ourselves in a position where we're going through a review. Businesses, industry does not like unpredictability. We need certainty. And I think that's as important for the United States as for us, because there are, and recognizing in Congress today, there are business leaders in the United States knocking on those doors and saying it is important for us to move forward. When we think about the supply chain, when we think about the way in which we obviously deal with critical minerals, manufacturing, agriculture, look, you know, we can go back to the 1960s when we arranged and integrated through the auto pact. Now, auto is another area completely, but I think that right now, sending those messages, working with Americans to share those points are important. And yesterday, how nice it was to hear Pete Extra, U.S. Ambassador to Canada, offer the point of something positive in light of what our Prime Minister said.
And I just want to go back to what you mentioned about irritants. What are some of the irritants, do you think, and how much of a factor is China and our talks with China?
Great question. So first of all, one of the irritants clearly is dealing with dairy, but I do think that, you know, dealing with some of those issues in our, you know, the way in which we deal with a market, there are ways to approach it. China, and it's really interesting, is today the foreign minister of China happens to be here in Ottawa, and I think it's important to recognize that Canada can be a very important vehicle also with for the United States, but working with the United States to address China issues. I mean, our trade with China, first of all, is 1/10 of what it is with the United States. There's no comparison. And let's remember when it was Pierre Trudeau that went to China, effectively opening the door for the United States to then enter into their relationship with China. So this is why we work well together. When we put our minds to it, we're far, far better than the sum of our parts when we work together on that. And we can help make America great again. But it's a question of how the Americans look to us and how we sit down with them to address global issues, while we also work very hard to diversify our trade. There's no question Americans are better off if we're also strong in terms of our economy. We have countries that we work with that then maybe, you know, make an investment in the United States, hear from Canada. These are all very exciting moments in terms of being able to look at it. If we look at it positive, and we understand really the geopolitics of the world, in fact, oblige us to work together and recognize the value of our partnership as we have it.
And is there a real danger that if this drags on and we don't have something a little solid by July 1st, that the U.S., companies down in the U.S. start looking and going, you know what, we're figuring out ways to adapt and not need the Canadians, and maybe we don't get that business back even if we do get a deal?
No question. That would be a sad day, because I think that it would not be easy for them. It would be tough for us. And there's no doubt. I mean, our numbers today demonstrate that, you know, we're not doing as well as we would like to. As we see, we can see interest rates rising. That would not be a good thing either. But they'll feel that in the United States as well. I mean, there are certain things that they don't have that we do have. First of all, the ability of us being able to work on the energy front. When we look at the opportunity there, which is incredible. Critical minerals. You remember we had a few months ago this whole issue with respect to potash. The Americans don't have the potash we have. So it would be very difficult to get that. And actually, while we are working right now to invest in mining and being able to get at those critical minerals, far better for the Americans, I like to say our cousins, to get that from us rather than try to get that from China and elsewhere. So it's a question of how we work together. There's not a lot of logic if we actually don't do that.
That was Jacques Shore, Government Affairs and Trade Partner at Gowling WLG. Well, drivers in some parts of the country woke up this morning to some of the lowest gas prices we've seen in more than a month. CTV's BC Bureau Chief Andrew Johnson has more on the dip, how long it may last, and why drivers on the West Coast aren't getting any relief.
Varun Sharma is spending $500 per week right now gassing up his cab.
Still lucky I'm driving hybrid, but it really hurts.
But after months of eye-popping prices fueled by the war in Iran, drivers in many parts of the country are getting a bit of a break.
Finally, a little bit of good news when it comes to filling your tank.
Drivers in Toronto were greeted this morning with $173.9 on the sign, the lowest price since April. The reason? A drop in oil prices over optimism the U.S. and Iran are close to a deal. And issues at refineries in the U.S. Midwest that supply Ontario have now been cleared up. As drivers in many parts of Ontario and Quebec revel in this dip on the gas price roller coaster, here in Vancouver, people are still paying on average well over $2 per liter. In fact, as prices fall back east, They're actually rising on the West Coast. What gives? Experts say it's now BC dealing with refinery trouble. A disruption in California, coupled with Canada's highest gas taxes, have forced people at this station to cough up $2.14.9 per litre.
How much does it cost to fill your tank?
Well over $100, like 130, 100 probably.
Finally, what Gas Buddy's Patrick DeHaan calls the million-dollar question, where people are paying less, how long could it last?
100% contingent on what comes of these negotiations between the U.S. and Iran. There probably has not been such a major impact to supply in my career, exceeding 25 years.
It's no million-dollar answer, but the one Canadians will just have to live with. Andrew Johnson, CTV News, Vancouver.
Okay, that does it for today's program. Thank you so much for watching.